Hey, what's going on everyone? Thanks for checking out this video. My name is Travis from Master the Market, and I wanted to make this quick video to talk a little bit about why I don't think penny stocks make good long-term investments. And this may come as a bit of a surprise because on this channel I talk a lot about how I day trade penny stocks, but it's important to keep in mind that short-term trading such as day trading and even swing trading are much different from long-term investing. And in this video I'm going to go over 5 reasons why penny stocks are generally not going to make good long-term investments, and why you're going to probably have better luck by looking into more reliable companies and more reliable stocks for your long-term investments. And the first of those 5 reasons is that penny stocks are going to most often be in long-term downtrends. And when you think about a trend in the market, whether it be an uptrend or a downtrend, it's always going to be in your best interest to go with the trend rather than trying to fight the trend. And if a stock is in a downtrend, you're going to be fighting that trend by trying to buy into that stock and trying to predict the exact bottom of the move. The same is true for a stock that's in an uptrend. If it's uptrending, the way that you would ride that momentum and take advantage of that momentum is by buying into the stock and by trying to short sell it and predict the exact top of the move. In that case, you would be fighting the trend of an uptrending stock. And really with penny stocks, when you try to buy into the bottom of a move while the stock is in a downtrend, that's often referred to as trying to, quote unquote, catch a falling knife. Odds are by doing this, you're going to get cut, and odds are by doing this, you're probably going to take a loss on the investment. So if we take the example here with SNDL, we're looking at, again, the long-term chart, so we're looking at the daily chart in this example, and you can see that it is, of course, in a long-term downtrend, making both lower lows and lower highs along the way. And I wanted to use this example because SNDL actually recently had a pretty big spike up from its low of 13 cents all the way up to a high of 60 cents per share just a few days later. And it's very common for these types of penny stocks to be in a long-term downtrend, but still every once in a while have a big spike up in their stock. So when that happens, a lot of people get interested and try to invest in these thinking that the bottom of the move is in and the stock is going to reverse and start to actually trend upward. But when this happens, you have to actually ask yourself, has anything with the company itself actually changed? Or is this just a short-term temporary bounce in the stock price before it comes straight back down and continues with its downtrend? Most of the time, you're going to find the answer is just that the stock has had a temporary bounce, and there's nothing wrong with taking advantage of that temporary bounce by day trading it or swing trading it, but you can't look at it as a long-term investment if the underlying company is still performing the same, because the stock is most likely going to continue performing the same as well. Okay, and that's going to lead us to reason number 2, which is that penny stocks are most often going to have poor financials. Every penny stock on the market represents an underlying company, and these penny stocks are penny stocks for a reason. Most of the time, the companies that they represent are going to be very poor financially. They're not very profitable companies, they don't have strong revenues, they're not showing EPS growth, and odds are they're not going to be the next Apple, they're not going to be the next Amazon, and they're probably not going to be a great long-term investment. A few things that you do want to look for when it comes to a good long-term investment. First is a current quarterly earnings per share or EPS growth of at least 20%. Following that, you want to see also that there is an annual EPS growth of at least 20%. And you want to see that there is ideally some high institutional ownership in the stock. By doing your research, you're going to find that there is very few penny stocks that actually meet these 3 criteria, because again, penny stocks are usually going to have much more poor financials. And one way that you can look for stocks that actually meet this criteria is by using finviz.com. So all you have to do is go over to Finviz and click on Screener up here at the top. And because this is fundamental data rather than technical data, we're going to go ahead and click on Fundamental. And you can see right here from the start, we have a total of 7,622 stocks here in this screener. And to narrow this down, we're going to first look for an EPS growth quarter over quarter of at least 20%. Followed by EPS growth over the past year of at least 20%, followed lastly by institutional ownership of at least 30%. You can see that right off the bat, we already narrowed the market down to a total of 380 stocks, all meeting these 3 financial criteria. And what you're going to notice is that if you hover over the price of these stocks over here on the right side, you can see that very few of them are actually penny stocks. And that's again because most penny stocks are not going to have strong enough financials to meet this criteria, which again is one of the big reasons why penny stocks are not going to make great long-term investments. Okay, and that's going to lead to number 3, which is that penny stocks often have dilution. In its simplest form, what dilution does is drives the stock price lower by creating a huge amount of supply in the market. At the end of the day, the market is going to move solely based on supply and demand. If there's more demand than there is supply at a certain price, that demand is going to push the stock price higher. And if there's more supply than there is demand, meaning that there's more sellers than there is buyers at a certain price, that supply is going to push the stock's price lower. And dilution is very commonly seen in penny stocks, which creates, again, a large amount of supply and is going to most likely push the price of the stock down lower. So for that reason, whether you're day trading, swing trading, or looking for a long-term investment, one thing that I always recommend doing is going onto a website like bamsec.com, or even something like sec.gov or otcmarkets.com, somewhere where you can look for SEC filings in a company and checking to see if there's been any recent dilution in the stock. So I'm going to go ahead and search for TTNP. This was an example of a stock also that recently had somewhat of a spike up. You can see that down here, it spiked from a low of about 11 cents per share all the way up to about 25 cents per share within just a few days, and then came straight back down, which is very commonly seen with penny stocks because they often fail to hold their gains when they spike up. And in this case, the reason that it came straight back down and actually ended up going even lower is because the day after this spike here, under prospectuses and registrations on bamsec.com, you can see we have a 424B5 filing, which tells us that the company is doing some kind of dilution. So in this case, what this offering and what this dilution is telling us is that there's 80 million units, each one consisting of 1 share of common stock as well as 1 warrant, which is going to be sold into the market for this stock. So essentially, it's creating 80 million extra shares of supply, which is going to, of course, take a huge amount of demand for the stock to actually break through and continue pushing higher. So what ends up happening is all that supply just drives the price of the stock even lower. And while this does happen every once in a while with large cap stocks, it is definitely much more common with penny stocks and is one of the big reasons why penny stocks make such risky long-term investments. Okay, so number 4 is going to be that penny stocks also have less liquidity and less volume. Liquidity and volume is very important because every time that you buy shares, there has to be somebody on the other side of the trade to actually sell you those shares. And vice versa, every time you sell shares, there has to be somebody on the other side to actually buy those shares from you. So when you're trading or investing in these illiquid penny stocks that on any given day may only trade a few thousand shares here and there, it can often be very difficult to actually find somebody on the other side when you're looking to buy or looking to sell your shares. In my opinion, when I'm looking for either a day trade, a swing trade, or even a long-term investment, I like to see that there's at least an average volume of 100,000 shares every single day. Anything below that, no matter how many shares you're trading, even if it's just a few hundred or a few thousand shares, it can be difficult to find somebody on the other side of the trade to buy your shares from you or to sell your shares to. So going back to the FinViz screener that we talked about just a minute ago, you can also put in average volume criteria as well to narrow the market down even further. So because this is technical data, we want to go ahead to all. And then down here on average volume, we're going to go ahead and select over 100,000 shares. So now we know that every single stock in this list is going to not only have EPS growth over the past quarter and over the past year, as well as institutional ownership of at least 30%, but they're also going to have enough volume for us to actually take a position in, knowing that they're not too illiquid and we're not going to have any issues trying to buy or sell shares. And really that is going to go hand in hand with number 5, which is that penny stocks are much more easily manipulated than larger price stocks. One of the big ways that penny stocks are often manipulated is with pump and dumps. And what this ends up doing is causes inexperienced traders to buy into the stock all the way up at the high, right before the people that were promoting the stock start to sell and drive the price of the stock back down. So what happens is the people that pump the stock up end up making a nice profit on the trade, while the traders that were late to buy into the stock end up taking a loss on the trade. And we actually had a really good example of this just a few weeks ago. If we look at WEI, you can see that this was a stock that went from a low of about 73 cents all the way up to about $5.50. And actually in after hours on this day, it ended up getting up to over $10 per share. and there was no news or anything to back up this big spike up in the stock. So because it was a pump and dump, the price ended up getting dumped straight back down, and now it's all the way back to $1.46 per share. But this just goes to show that penny stocks, again, can be much more easily manipulated. And generally speaking, you don't want to be heavily invested in something long term if it can be so easily manipulated. Okay, so those 5 reasons are why I think penny stocks are much riskier long-term investments, and why I personally believe they should be only used for day trading or even swing trading. Hopefully you found some value in this video, and if you enjoyed, please make sure to give it a like and subscribe to the channel so you don't miss out on future uploads. Also, if you want to learn about day trading, swing trading, and other long-term investing strategies, all of that can be found at my website, Master the Market, which is going to be the first link down below in the description. But anyway, thank you for watching. I hope you enjoyed, and good luck with your trading and investing.